Hi, welcome to Learn Debits and Credits with me, John. Today we're going over T accounts and we are going to be using our resource, learndebitsandcredits.com. This is a free ebook. Go ahead and get that. Also, it's at accountingplay.com/downloads if for some reason you get rerouted. So let's go ahead and get right into revenue T account transactions. Revenue increases with a credit. I got revenue credits, expenses as debits. Revenue credits, expenses, debits. So, increase revenue with the credit. Revenue, as you're making money, is pretty much going to be constantly increasing. Typically not reverse. So, it's going to be going up, 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 credit, 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 credit revenue up, credit interest income up. Anything that is associated with revenue making sales. So let's get right into our materials. Okay, so here we are with a sales revenue T account with our debits and credits. I'm also going to be referencing our Learn Debits and Credits ebook. So here's our famous accounting diagram. Now we've come to our income statement accounts. And now we're talking about income. Increasing income with a credit. Increasing income with a credit. Just got to memorize that. So let's look at some income accounts here. Revenue. Sales revenue. That's when you sell something. If you're doing accrual-based accounting, which is pretty much textbook accounting, you will show the revenue when the sale is made. Not necessarily when it's shipped, so it depends on the methodology being used. Realized gain. Let's say you sell an investment. Unrealized gain can be its own particular type of revenue account, but that's beyond the scope of this conversation. Interest income, miscellaneous income, extraordinary income, it's all pretty much income to the business. So let's go ahead and take a quick peek one more time at the accounting equation. We're in the income, credit income up. Rarely are you going to reduce income. So let's go ahead and see what's going on here. So now we have Mr. T, sales revenue account. Now if you want to have different T accounts, there are plenty of templates in the ebook. So remembering, revenue credits, expenses as debits. So let's credit the sales revenue up. So you see here our transactions were increasing 10,000, 10,000. So I'm just going to run the whole thing through. Increase credit 10,000. Increase credit 5,000. Now why the heck would revenue decrease? Now this is not a decrease as in revenue has been declining over time. This is an accumulation of all the revenue. So let's go ahead and say what happened here is a sales return. So the effect is zero revenue. So let me go ahead and get sales return into here just for our reference so you can see it and so you know. Now we have another increase of 10,000, 10,000. I'm going to sum up the accumulated transactions in each account. So 25,000 on the credit side. Go ahead and get us a nice little border here. Bring that border all the way across. We have on the debit side 5,000. So what is going to remain is a $5,000 reduction of this credit. And we now have $20,000. So that's an idea of how the sales revenue account might look after these transactions, 20,000 remaining. Go ahead and show you right there. So we increase, increase, decrease, increase. So from the top, we reverse all this good stuff. We start out with increasing revenue with a credit of 10,000. Another 5,000 increase, decrease 5,000, for sales return. We have another increase, summing both columns up, figuring out what remains, 20,000. Now let's talk about investment income just a moment. All right, so we did some basic sales revenue transaction and what was a return. You've only seen one T account here. In the background, there's always two T accounts going. So just remember that. This is just the beginning. Increase revenue with the credit. Revenue credits, expenses as debits. Burn it into your brain. Now we're going to talk about investment income. Investment income, these are all components of the income statement, but they're not always at the very top. Sometimes investment income can be at the very bottom of the statement because that might not be the primary operation of the business. But all we need to know right now is that income, credit it. Let's do this. All right, so we're back to investment income, and now we're just increasing. Let's go ahead and say these are some dividends that are being received by the company, and they just come in the mail basically. So now these are simplified investment income, right? Nothing too complicated. Credit 500. Increase income with a credit. Credit 200. Great. Increase with the credit. Credit 100. Increase income with the credit. Credit 1,000. Increase income with a credit. And let's sum them up. 1,800. And that's how it would be increasing. Going back to learndebitsandcredits.com ebook, you'll see here what's going on here. All right? So thanks so much. I'm John at accountingplay.com. Email me. Tell me how this is going for you. Is this helpful? Subscribe. Let me get in touch so I can tell you about our apps, the video course at learndebitsandcredits.com. The full course, clean, additional content, organized, not jumbled up like some of the other free content that you might be seeing. So if you want to support me, please hit me up there, and I really appreciate it. Thanks so much.